Hello there, my name is Elizabeth Ferty and I'm the Programme Director for Pensions and Investments World Pension Summit. And today I'm joined by John Reade, Chief Market Strategist and MD of Research for the World Gold Council and sometime big friend of World Pension Summit. Hi John, how are you doing?
Very well, thanks Liz. It's good to be back talking to you guys.
Yeah, well, it's great to have you here. So, John, you'll be joining us for the third time at World Pension Summit. I think it's the third time with me, anyway. World Pension Summit. Very, very glad that you're coming back. And so, I just want to find out a little bit about what's been going on in the world of gold and the World Gold Council since we spoke a year ago. So, if I remember back, 2020, bit of a strange year, but gold was one of the best performing asset classes. It ended up about 25%, which is brilliant for the gold bucks. So, why is it not performed in the same way? Why is it underperformed in comparison in 2021? Because there's lots of the same, let's be honest, pandemic drivers. So why does it not work the same?
I think there's two reasons really. The first is effectively reflation. When we got the very good news about the vaccines that came out in November 2020, we saw a change in attitude towards perceptions in markets in general, looking to buy the recovery and anticipating that we would be, retreating from the nadir of the pandemic, which in general seems to be the case. Work we've done looking at previous reflationary areas, in other words, the time just after a US recession, shows that gold does tend to underperform a bit there, certainly over the first 6 months, and that it catches up in a sort of 12, 24, 36 month time frame. So in that respect, it's fairly normal. I guess the other thing I'd say as well is that we're seeing really strong equity markets, particularly in the US. And if all you're doing is buying the dip and equity markets go on to hit new highs, virtually every week, then you'll need to own gold. In fact, your need to diversify at all is much reduced. So gold's not getting a lot of investment flows at the moment, partly because of reflation and partly because of just the strength of the S&P 500.
So interesting, John, thank you. And looking forward, the Fed has said that it will begin to taper, hopefully without the taper tantrum that we saw last time or the time before or the time before. And rates are going to come back up because they have to at some point. So does it still make sense, or does it make sense to hold gold tactically in this case?
I think so, yes, and really for two reasons. The first of which is, yes, we're going to see interest rates move higher. I don't think there's any doubt about that. The timing, of course, is to be determined, but they will move higher from here. But they're likely to remain at very low levels, and those very low levels are conducive to decent gold price performance. I think the second thing, though, was illustrated really well last year. I don't think anybody had coronavirus pandemic on their playbook for 2020 when they were writing their outlooks in November and December of 2019. And yet that's what we got. And gold performed extremely well, up about 25%, one of the best performing asset classes that we saw. So gold's role as a hedge against the unexpected, not just the hopefully forecastable economic cycle, but the real grey and black swan events that tend to see gold perform particularly well. I think that's a justification for having it in a portfolio, even in an environment where we're expecting interest rates to rise modestly over the next few years.
Right, I'm fearing the interest rate hike because I've got a mortgage, but that's a different conversation. I suppose associated with that, we're looking at inflation, and the talk this year has been about inflation. Will it come? Will it stay? Is it going to get bigger, better, worse, whatever your view is on it? And gold has always been an inflation hedge, or in recent times, or even in longer times. Is that still true of the asset? Can we still call it it's a good asset to hold in inflationary times?
Yes, but with some caveats. The work that we've done shows that gold isn't actually a very good mathematical hedge for CPI, particularly over the last 20 or 30 years. And I think the reason for that is that the big inflations that we saw in the 70s and the 80s have really been not repeated since then. Since Volcker came and started to crush inflation in the US, there's been greatly diminished fear about inflation, and gold has been driven by other factors. Now, I'm very much of the view that most of, if not all of, this inflation surge that we're seeing at the moment will prove to be transitory. But if that isn't the case, and if we're about to see a real change in the longer term inflation outlook, breaking that link that really was established back in 1980, then I suspect gold will be a lot more of an effective CPI hedge. What I would say, though, is the work that we've looked at with inflation more broadly, just beyond CPI, suggests that gold is actually very well correlated to the level of US M2 money supply. And obviously, that's increased tremendously through the pandemic. And that may be one of the reasons why gold did so well last year, was because of very rapid money supply growth. So in the end, I think it's fair to say that gold is an imperfect inflation hedge. And we advise people that if you're looking at a portfolio of assets to hedge against inflation, gold should certainly be one of them, but it shouldn't be the only one that you have.
Thanks, John. I shall look into my own portfolio and take your advice. So finally, do you still think, I think I know what the answer is going to be, but do you think, is there still a case for gold to be held as a strategic asset in portfolios, and why might that be?
Indeed. I mean, we still believe in the strategic case for gold. I don't think anything has really changed with that argument over the last 12 months. The fact that gold prices increased a lot in 2020 and have underperformed a little bit this year hasn't changed the argument. If you look over the longer term, gold's been a source of returns over the last 10 years, over the last 20 years, and since 1971, when we came off the gold standard. Those returns have been in line with most other asset classes and better than many. Gold's a diversifier that works particularly well when you really need it, such as when equity markets fall sharply like they did last year because of the coronavirus pandemic. Gold's liquid, so you can get in and you can get out if you need a source of liquidity during shocks. Something else that we've seen in gold being used as a source of liquidity during crises in the recent and less recent past. It's also not as volatile, I think, as many people think, with volatility in line with major equity indices, and certainly much less than other commodities or single stocks. And then finally, it's the impact that gold has on portfolios. If you had an allocation to gold in pretty much any portfolio that you've got over the last 10 years, it would have increased the risk-adjusted return of that portfolio. And ultimately, that's what you're looking for an asset, particularly that is a diversifier in case really bad things happen. So no, I think gold still deserves a strategic role in virtually every portfolio we've examined.
Brilliant. Well, that is a very interesting and informative way of looking at it. Thank you ever so much, John. Entertaining and informative as ever. I'm looking forward to seeing you again, hopefully in person, very much hopefully in person in October at World Pension Summit, and where we're going to talk a lot more about gold and everything else that institutional investors need to be thinking about. Thanks ever so much, and see you very soon.
Thank you, Liz. I'm looking forward to my first business trip since March 2020.
Fingers crossed. Thanks, John.